Let me show you how I use swing points in the market to take this high probability 2.32R trade and many more trades like this. The truth is, most traders don't understand truly swing points in the market and how to use them to ensure they don't get stopped out of trades before trades run to their take profit. So let's run through it. I'm going to look at a quick example on Euro New Zealand dollar before diving onto GBP CAD. So right here in the market, we have bearish price action. We have a bullish candle. We have bullish momentum in the market that then sells off, creating a bearish order block. And we're analyzing the 12-hour time frame right now. Then we see a trade back into the order block and a continuation lower. We then trade back into this order block, this internal range liquidity, and again sell off, closing below the low, before eventually we see a shift above this swing high in the market. Price then trades back into the newly formed 12-hour bullish order block before continuing to our higher time frame targets. So from a swing point perspective, all we need to do is understand how price legs are created and what are the highest points and lowest points in those swing legs so that we can take advantage of shifts in the market. So right here, when we get this sell-off, this bearish candle, we have a high that created a low in the market, a bearish price leg. So I'm going to mark this in red. And in doing so, we create a 12-hour order block right here. So bullish to bearish price action. Price then trades back into this order block right here and then sells off again to the low. So we get the formation of a new bearish price leg. We can then mark again the order block right here, 12-hour order block, and then see what happens. We get a trade back into this area and then price sells off again and again closes below this bullish candle, creating another 12-hour order block right here. At this point, we then see price trade down, try to go lower, but shift back above the creation of this bearish price leg. And in doing so, we create a bullish price leg, which I'll mark in green. And all we see then is the shift from bearish intention in the market to bullish intention in the market. And if we're thinking about marking swing points, we can simply mark them as the highs and lows of our price legs. So there's the swing high, there's the swing low, gets traded through. We get a new swing high and a new swing low, then again gets traded through. We get a new swing high, and eventually this gets closed through in the opposing direction. We get the creation of a new bullish price leg, creating a new swing low. So purely from a price action perspective, we have a shift. Now, if I overlay higher time frame context in the form of this 2-week candle, we can see that we are raiding below the we're targeting the external range liquidity below this 2-week candle, this entire piece of price action for the last 2 weeks. And actually, I'm just going to shift this around slightly so it's easier to see. But we then get a structure shift in context because we've raided the liquidity below this low. Now, if I just shift this over to the 1-week time frame rather than the 2-week time frame, we can look for targets in the market. And what we see is that this here is a weekly candle. This entire range is the 2-week candle, but we get a shift below this weekly candle and a close inside this candle's range. So this exposes the high of this candle that we've manipulated as our short-term trading target. So we have a shift in structure, we have a close above a swing point in the market, we have the creation of a new swing low in the form of this price leg being created. So then we can mark our internal point of liquidity, which sits right here. It's our order block. We have this last sell to buy candle. So I can simply place an order at the order block right here, covering the low in the market that I know is going to be protected, and target the high, the previous week's high that we manipulated below. And this plays out for a 2.48R trade. So let's just dive into a quick bit of theory. So what is a high or swing high or a swing low? Essentially, it's the highest point price reached before reversing lower, and a swing low is the lowest point price reached before reversing higher. But the critical point here is that the swing low and swing high, they denote the highest and lowest point in any given price leg on the time frame that you're analyzing. So most traders look at a chart and just eyeball swing highs and lows. They mark what looks like a high or a low without a consistent rule. And this is why most traders struggle with market structure. They have no actual framework for effectively qualifying swing points. Why does it matter? Because swing points get protected. So if you know where to place your stop loss, you'll have a higher win rate. And the key is combining swing points with higher time frame context. Let's look at another example. So right here we see on Euro New Zealand dollar that looking at the 2-week time frame again, what do we see? Price raids the external range liquidity at this 2 weeks high. It then closes inside this range, and in doing so we expose the low of that candle as a higher time frame target. So now we can just map our swing points. So we have bullish price action right here, which is price uses to target this external range liquidity. Then we get the formation of a bearish price leg. I'll mark this in red. So at first it's quite hard to see because you're still in the context of this bullish range. But we then get a sell off right here and the creation of a new bearish price leg. So we can start to map our swing points. So this was our swing low and this was our swing high. And as you see, price traded and closed below the swing low. At that point, we get the creation of a new price leg. So when price is retracing in to the order block or the fair value gap, let's call it the order block, if we just simply cover the high and trade towards the low, we get another very effective 2.44R swing trade. And yes, we get consolidation in here, but there are several opportunities to get involved in this trade. And that is how you use protected swing points in the market to take these types of swing trades. Let's look at another example on GBP CAD. So right here, we get a liquidation of a 2-week candle's low. So right here in this price action here, we see a close of a 2-week candle. We then get manipulation below and a close inside this candle's range. So at that point, we expose the high of this candle as our higher time frame trading target. Then we can simply map our price legs. So we get a sell-off, a bearish sell-off right here. So we have swing highs and swing lows in the market. Then there's consolidation. We then get the formation of a new price leg lower, because what happens if this is our swing high and this is our swing low, we close through the swing low. We then create a new swing high in the market. And again, the exact same thing happens. It gets targeted and closed through. We have our liquidation. We have our higher time frame target. So we can now map the bullish price legs in the market. So here we have a sell candle before the buy. So this is our bullish price leg right here. And what happens? We get consolidation within the price leg. Within the price range. The price trades down. It does target the low, but it never actually closes below the low. And at this point here, we get a shift. And at that shift, we get the creation of a new bullish price leg right here. So we can be very confident in the creation of this order block. It's 12-hour order block right here. The price is going to sting in and then continue to our targets. And so by just placing a trade from the order block, covering the newly created swing low, which sits right here, we can then hold this trade to our higher time frame target which plays out for a plus 3R trade. So that is how to use swing highs and swing lows in the market in combination with higher time frame candles to take more high probability trades. So how do you apply this? Always track your higher time frame candle closures. I have a lot more content on trading candle ranges, so don't worry, use that content to understand which candle ranges are going to be respected and disrespected. Then mark your confirmed swing highs and swing lows in the creation of price legs on your execution time frame. Then use those swing points to mark shifts in market structure, and I'm going to do a whole video on market structure that you can check out. Combine this with internal range liquidity, so the liquidity that exists in those price legs, to take entries covering with your stop the swing lows that we know are going to be respected in the market, and always trade back to the highs, the external range liquidity that sits at the highs and lows of those higher time frame candles. So I track and analyze 32 Forex pairs, including gold, silver, Bitcoin, and I track 12-hour price action in conjunction with monthly, 2-weekly, and weekly candles to swing trade positions. By doing this consistently, it's just a case of executing. Once you get good at it, you can do it in less than 10 minutes per day, especially if you're consistent. So for more content on truly understanding why price does exactly what it does, please subscribe and follow along. See you on the next one.